Hello and welcome to Globaleye's weekly look at what's been happening in the global stock markets. And joining me as ever to discuss these matters is our Senior Wealth Manager, Simon Putt. Simon, thank you once again for joining us.
Thank you.
Let's start with some political movements over the past week, in particular Theresa May calling a snap election in the UK, and of course the first round of the French presidential election. What impact has that had on stock markets and currency markets?
Certainly a dramatic impact. Looking at the UK first, the announcement by Theresa May caught the markets by surprise, caught the country by surprise. The first reaction that you would draw attention to was actually on the currency rather than the markets, and sterling rallied straight off the back of the announcement. We moved from a region of around $123, $124 to the pound to 128, the highest level that we've been at for some months. Thereafter, we see the impact on stock markets, and the FTSE 100 in particular sold off quite notably last week, which really reverses the trade that we've seen over the last few months. And a big part of the rally in the UK stock markets has been off the back of the weak currency. The preponderance of the FTSE 100, which is made up of export-driven companies or companies with very international profiles for whom a weak sterling currency is beneficial, well, that trade got unwound. Stronger currency, weaker stock markets. And so, as I say, we saw the FTSE 100 languish throughout the course of last week. But then over the course of this weekend, with the first round election result in France and a more EU-friendly result coming, with Macron emerging as one of the two candidates to go through to the final round of voting, markets have responded very positively. They were worried about a worst-case scenario with the far-left candidate coming up against Madame Le Pen in the final round. The fact that we haven't had that has been very positive for markets, and we've seen a good rally this week. And as far as the UK is concerned, the market has made up almost half of the ground that it lost last week.
Okay, so with the geopolitical situation in the United Kingdom, in France, there are still issues about the direction of the Trump administration, volatile times potentially ahead. What should the man in the street investor be doing right now?
We've been saying the same thing time and time again, that asset diversity is key. There's still the potential for growth in the markets. The IMF last week increased its growth prospect for global economy, 3.5% GDP. The US economy is doing fairly robust things at the moment. The Fed is trying to mute the pace of growth. Europe looks well poised for post-election phase to do well. Emerging markets are doing well, so there's growth in the system, and the ability to investors to capture that comes from some exposure to equities. But obviously, equities are a very volatile sector. An investor wouldn't want to be 100% exposed to the equity asset. So as I say, we've been advocating for a long time multi-asset approach. So have a portfolio that comprises equities by all means, but also has a decent makeup of fixed income, cash, commodities, property. So at least if we do face challenged times through the geopolitics, as you say, or through volatility due to elections, then the presence of fixed income, of cash, would provide some insulation, some downside protection, as it were, to adverse developments in the equity markets. We've been consistent in that approach. We continue to make it that investors can still capture growth, but they should at least protect themselves against the more negative scenarios, which will likely come from time to time.
Okay, let's turn to the price of oil, Simon. The last few weeks we've seen oil bounce back really, $55, $56 a barrel for Brent crude. But last week it fell off a cliff, didn't it? It was $52. Any particular reason for that?
Not a massive reason beyond the fact that there's greater perception that US supply is picking up. Shale is picking up steam again. I think shale is a wiser animal than it was last year in terms of having a more streamlined cost environment for the production of this particular brand of oil. So the shale companies have been recovering and turning the taps back on, as it were. And as I say, it's this threat of supply that's hit the oil price. In terms of where this leaves us going forward, I think we may well see a counter to that, though, coming from the side of OPEC. The continuation of the production cuts are expected to remain in force, and that will provide a counterbalancing force to shale. And it's something that we've talked about in previous discussions, that you're on a sort of push and pull type strategy here with shale on the one side, OPEC on the other. And we see ourselves around this sort of $50 level is really where we're going to be going forward, and it almost looks like a kind of sweet spot for the market now. It's decent enough for companies, for economies to make profits, but it's not so hefty that it's going to start hitting the consumer or creating an adverse demand-supply dynamic with more and more supply hitting the market.
Simon, once again, thanks for joining us.
My pleasure, thank you.